Hello and welcome back. If you missed last week's session, I highly encourage you to go back and watch it. Last week we discussed registered accounts and whether they're a ticking tax bomb. So we're going to continue that conversation today. I've brought some receipts. We're going to look at some numbers in a calculator and we're really going to geek out on the numbers. If you have been with me for a while, you know that I am really a numbers geek at heart. I love spreadsheets. I love math. And so I have to prove the math to myself before I'm confident to share it with anyone else. And in this case, I really just want to show you how different types of investments compare to each other. So I'm not telling you what to think. This is not investment advice. It's not tax advice. I am just sharing my observations of what I've seen in my dealings with clients and what I have worked out through these calculators. So I'm going to share some numbers. Please don't get hung up on the numbers. I use a calculator that shows really complicated math in the background. But again, please just don't get caught up on the numbers. This is just an illustration. Everybody's case is different. And when you're a client of mine, we're going to run through your numbers. We're going to look at what you have saved, what you have going on. And when we start going, we want to look at your finances as a whole. And we want to see holistically that what you're doing is going to work through all phases of your life. Now, there's three stages to retirement planning, and I feel like a lot of people get really hung up on the first stage, that accumulation phase, when you're saving money towards that retirement goal. Okay, we all live with this goal in the future where one day I'm just not going to have to work, and we all have a magic number that you're going to need to hit that goal. So we want to look at your whole situation, right? We want to see what kind of passive income you're creating so that you don't have to have as much in savings and you have assets that are going to generate that money for you. Now, that's of course only a part of it. The other part, of course, is the distribution phase. So when you start taking money out of those accounts, at that point, we also want to make sure that we're being as efficient as we can, both with taxes and again, with how you have money working for you. What kind of assets do you have that are giving you passive income so that you maybe don't need to pull as much from your savings? Are you being as efficient tax-wise as you can? Again, we want to look at all of that holistically. And then finally, and a lot of people sadly miss this until it's too late, but you want to look at your own mortality. And it sounds morbid, but you want to have a plan in place for what would happen if you pass away sooner than expected. You want to know that your money that you have saved all these years for, you want to know that's going to go where you want it to go. If that's the CRA, great. It's probably good. Whatever it's doing, they're going to get their cut of it. If you don't want the CRA to be your primary beneficiary, then you really need to plan for that ahead of time. And you don't want to be surprised at the end, or worse, leave your family surprised at the end. So, like I said, registered accounts, they can't be beat in the accumulation phase. So, when you're saving money, it makes sense, of course. You're getting a tax break on that cash, so you don't have to pay tax the year that you've made the money. You're not paying tax on that. You're also not paying tax on the growth. And so as it grows, you have more and more of a principal that's going to be earning interest. And that's, of course, why we're all sold on the registered accounts in the early stages. The problem with that is that tax bill is going to catch up with you eventually. And again, I'm not saying don't save in registered accounts. What I'm saying is you have to be cognizant of what's going to happen with them at the end. And so if you take into account what's going to happen when you start pulling money out, are you going to be in a higher tax bracket? What's your plan there? What can you do in other areas of your life to plan for that so that your earned income is less? Maybe you have passive income coming in from other things where you're earning dividends or you're earning through like capital gains. These things aren't taxed in the same way. So it's very important that we look at everything holistically. Tax-free savings account are also really good. You do pay tax when the money goes in, but once it's in, you're accumulating again tax-free. These are awesome for just about any savings. I would say max those out before the registered accounts if you can. Tax-free savings give you the benefit of that growing money without having that tax bill at the end. So they're awesome for that. The downside, of course, is that you can't put as much money in, and it is after tax dollars. So you do pay tax on the money before it goes in, but you don't have to pay tax again. So if you have that in a really high performing account, you're not going to be paying tax on all of those gains. So again, we just want to be efficient with what we're doing. Now I want to share a calculator here. So give me a second. We're just going to follow the retirement savings through a young man. He's starting when he's 30. He makes about $100,000 a year and he's really good at saving into his RSP. So he's going to save $20,000 a year. Now, he's starting at the age of 30. He hasn't put anything in up to this point, and he's going to put in $20,000 a year. So if we look here, we can see that he's put in $720,000 total through the course of his lifetime, right? We see his age on the left as we keep scrolling down. By the age of 65, he's put in 720. After that point, he's going to start taking money out. Now, of course, he has money in an account. He is doing what he's told. He's put it into an S&P 500. The average rate of return for the S&P 500 over the last 70 years, so that's how long we're going to follow his lifetime, was 11.76%. Let's see what that does to our investment now. So now, if we look, by the time he's 99, he would have $447 million saved up from that 720 that he contributed through his lifetime. Amazing, right? If this was the case, we would all be buying into this. Like, run, right? Don't walk, run. But that's not really what happens. Most people don't realize that average rate of return is not showing what's actually happening in that account. So let's look at what the actual rate of return was for all of those years. Wow, that made a huge difference. I'm going to toggle that again. Pay close attention to this net account value here. So that's the account value at the age of 99. We went from 447, we switch off the average, to 256, almost in half. But we're not done there, okay? Because when you have money in funds like this one, you're charged MER, so management expense ratio, that is charged to the fund. That covers the people in the background who are buying and selling the stocks inside that fund and keeping really close tabs on it. Their job is to make that fund earning as much money as possible. Those management fees range anywhere between 2 and 3% for a high performing stock like this. We're just going to put it at 2%. And this is a very conservative number. I want you to know that because in addition to those MER fees, a lot of investment firms also charge an additional fee to that. So one that I'm familiar with, I've had a couple clients share their statements with me and we've moved their money out since then, but they were charged 1.5% on top of this. Okay, when we factor in just that 2% management fee, now we went from 245 million down to 77 million. Huge difference. Let's just look at what that 3.5% would look like if they had, actually, I'm going to bump it right up to 4.5. Let's say that they didn't understand how the fees work. So they're being charged a 3% MER plus another 1.5 from their firm. $17 million. Look at the difference that has made. This is why it's important, why you don't want to outsource your financial decisions. Okay, it sounds awful. I know, I'm sorry. You don't want to blindly go into your bank or the investment firm or whoever it is and just blindly say, yes, please take my money, manage it for me. You want to know exactly what all of these fees are, and you want to know how they're charged. You want to see those on your statement. So let's go back. I'm going to use that conservative 2%. With those funds, you can't really get around that. So 2% in the S&P 500, we have the variable rate, so the actual rate of return for all 30 years. Now, of course, he's going to have to start taking money out. So I've already looked it up, and when I plug in his $100,000 salary into an inflation calculator, inflation over the last 35 years was 2.71%. I'm going to multiply that by his salary. What that tells me is he would need $267,000 a year to have the same purchasing power that he did when he was 30. Now, I'm going to keep this number, but I just want you to be aware of the fact that is the cost of living of his living when he was 30. I don't know about you, but myself personally, I don't want to live in the same way that I did when I was 30. I want to be able to spend more money than I did when I was 30. I want to be able to travel. I want to be able to enjoy my life. So let's just be aware of that, okay? But for now, we're going to use that number. So he's going to take out $267,000 a year. We're not going to increase that with inflation. We'll just leave that as it is. Now, oh, that brought his net account value at age 100, brought it down to 26 million from 77. But he spent that money all good. We're not too worried about that. Of course, we're not done there because now, because this isn't a registered account, he hasn't paid tax on it all those years. So we're going to have to start taking taxes out on these withdrawals. Now, again, I'm just going to put him in Ontario. That's where I live. I can change this. Of course, if we're working with your numbers, this will be a little bit different. And when he's pulling money out, he's going to be making about $50,000 in earned income. I'll say earned income in quotation marks because that would be like his OAS, his CPP. So he's going to have $50,000. Let's look at that tax. So when he takes out 267, he's now taxed $118,000. He can now only spend 148. That is a big problem because now he doesn't have enough to even live like he did when he was 30. Yes, he has another $50,000 here, but again, we have to take into account that we want to live better than we did when we were 30. So let's just bump us up here. How do we get close to this 267? I actually did the math, and if he's pulling 520 every single year, then we get 266. It's pretty close in net spendable. So this is the cash that actually hits his bank account. But now look at what happened. He went from having $20 million at the age of 99. Now he's run out by the time he's 84. That's a problem. And I haven't even factored in what would happen because typically we don't keep all of our money in something really high risk as we're approaching retirement. Let's just say that he moved it when he was 60. So now I'm putting in bond rates. Now you notice that these are much higher bond rates than we're currently getting, right? Our current bond rates are like 2, 3% if you're lucky. Okay, he's run out of money by age 72. And that's not even factoring in that he would need some kind of life insurance at some point in his life. I can add that in too. That would shave another year off of what he can do. So let me just take that insurance out for a second. I'm not telling you what to think. I just want you to be aware of what can happen with these accounts. If we notice here, the problem that we're facing is that even if we want to live the same today down the road, right? We want to live the same as we do today. We're going to need more dollars. When you need more dollars, that's going to bump you up very likely to a higher tax bracket. So if the tax brackets stay the same, then at that point, he's going to be in a much higher tax bracket by the time he's retiring. When he retires, he's jumping from a 31% tax bracket to 48.8%. Huge difference. Another problem with that, okay? What if he passed away right when he retired? What if he passed away at 66? If he had a spouse, his registered account would just roll over to her. But what if he doesn't? Or what if she's already passed away? Then the CRA is going to tax that full amount, so 2.7 million at 48.8%. His kids are not going to see half of his savings that he worked so hard for his whole life. Who's taken all that money? We see how much has gone towards management fees, right? How much has gone towards taxes over the years. Again, not telling you what to think. I just want you to be aware of this, okay? So now everybody's going to ask me, okay, so if registered accounts are so bad, then what's good? The answer is that nothing is going to be the be all end all. Okay, your situation is going to depend on a lot of different things, and it's likely that you're going to need a variety of accounts to make everything efficient and to make it work for you. That's why it's so important that when you do work with someone that they're looking at everything as a whole picture. You don't want to be buying a GIC from this person and a registered account from this person and maybe another registered account from this person. You want everything to be not necessarily from the same place, but you want everything to work as a whole. Okay, when I work with my clients, I'm happy to sit down with their accountants or their other advisors and we come up with a holistic plan to make everything work together. Let's look at an overview of the different kinds of accounts that you could potentially be using. Registered accounts, I just went over. Biggest things that I want you to be aware of is the cost of using that kind of account. Yes, the accumulation is fantastic, but you don't have access to that money, or there's a very high cost of accessing that money if you need to dip into it early. What are the penalties of that? What if you have to take out money before you retire? What if you don't need the money when you retire? There's minimums that you have to take out once you hit the age of 71. You have to start pulling a minimum. That's going to bump up your earned income. So if you have income from other sources, that's likely going to bump you up to a higher tax bracket. Just things that you want to be cognizant of as you're planning this out for your life. Not as important when you're 30, but once you hit your 50s and your 60s, you want to make sure you have this well planned out. What happens if you get a lower rate of return? What happens if you do have your money in a more volatile investment and you lose money? What's that going to do to your plan? What if you have to take out money in a down market? You're locking in those losses. Not telling you what to think, that you just have to be aware of this, whatever type of account you're owning. TFSAs, I spoke on that briefly. I really like them. I like that the tax is now. So you're paying on the seed, not the growth. You're not going to pay on it again. I also like that the tax rate is known. So I would rather pay now, even if it's a higher tax rate than possibly in the future, because I don't know what the tax rate is going to be in the future. I know what it's going to be today. So TFSA, I would do that ahead of a registered account, so ahead of an RSP. Non-registered accounts, that's when it gets a little bit complicated because the taxation on those gets really complicated depending on what kind of investments you have. There's three ways that you can be taxed on that. You have interest. So if you're earning interest on something like a GIC, that's taxed as income. So that money, though, in those last years in that illustration that I showed you when we were looking at the bond rates, that's interest in the income. Okay. If that wasn't a registered account, you would be paying interest on that every year. You would be paying tax on the interest of those accounts every single year. So if they're really substantial accounts, you're going to be paying a substantial amount of interest, which is going to deplete those accounts. Dividends, a lot more complicated to figure out the taxation, but basically you are eligible for dividend tax credits. It doesn't count as earned income, which is a major plus if you are someone who owns a business. You can be taxed at potentially a lower tax bracket than it would be if it was taxed as earned income. You also don't have to pay CPP, and you're taxed on a lower marginal tax bracket because it doesn't count as part of your earned income. Finally, you have capital gains. So when you have an asset that you've bought, whether it's stocks or real estate, you have bought this thing, your capital gain is how much more you can sell it for. So when you dispose of that asset, your capital gain is how much more you have sold that asset for. So what is your earned portion of that? Okay. So just for an example, if you had a property that you paid $100,000 for, you did $100,000 in renovations and you later sold it for $1 million, capital gain would be $800,000. Now, does that mean that you're paying tax on $800,000? No. You pay tax on half of a capital gain. So 400,000 would be your gain. Okay, are you following still? 400,000 is your capital gain. That's how much you're taxed on. That 400,000 times your marginal tax rate, that is how much tax you would be paying. Again, it can be very substantial. That's when it might make sense to put money into a registered account so that you can offset that tax, that super high tax in that year, and then not have to pay on it that year. And then you can work on maybe drawing that down in future years. I'm not a tax expert. Talk with your tax accountant about those kind of strategies, but you just want to be aware as a consumer that these things exist. The pros of capital gains is that it's not taxed until it's realized. So until you sell that thing, that you're not taxed on it currently. That could change in the future. It can also be offset by losses. So if you have a huge capital gain and you have investments that you've also lost money on, you could sell those off and they can balance each other out. The con is, of course, that you're taxed when you sell it and then that your gains can be quite high. So I'm going to leave the training at that this week. I hope that was helpful. Let me know what you think. Let me know if you learned something, if there is something that you weren't aware of that you're going to take and find out more about how your accounts are set up. I encourage you to do that. I encourage you to learn more and more about how your money is working for you because the more you know, the more power you have over your life. And that is essentially what we're all looking for. So until next time, thank you so much.